nothing matters unless you commit to learning regardless of strategy. So, everybody watching this right now, you are committed to learning. You want to improve as a trader. Point in fact, because you're here watching this right now. So you want to improve, which is the first step and really the hardest step. What's great about trading is, you don't really have to reinvent the wheel. You just have to kind of study what the great traders have already done, learn the principles behind their system. Every trade that you make, whether it was a winner or a loser, has the potential to help you make better trades in the future. So your biggest loser might actually pay you way more than your biggest winner in the long term, because you might realize a mistake that you're making that just allows you to blow your overall performance out of the water because you fixed that step. Your own trading is the most important indicator that you have, because if you're not trading well, by definition, the market isn't right, or you're not right for that market, and you should take a step back. But if you're trading well, you should step on the gas and try to get the most out of that period where you're on top of your game and doing extremely well. You have to manage risk tightly and use stop losses. Not every market wizard who I've talked to uses stop losses specifically, but they all manage risk very tightly in some way or another. You have to set yourself up for and build a system for yourself that allows you to get there. And then you have to be disciplined enough to execute that system. All right, welcome back, everybody. It's my pleasure to also be presenting at this year's TraderLion conference. And first of all, I want to thank everybody for tuning in. It's been a fantastic bunch of days. All of the speakers have been excellent, and hopefully you guys have taken a lot out of the experience. And if you did, please consider going ahead and leave a like down below in the video, subscribing to the channel. We've got a whole lot in store in the coming months and years that you don't want to miss out on. So make sure to subscribe, 100% free, and help us reach that 100,000 subscribers mark. With that said, today I'm really looking forward to be presenting on a topic that I think can help a lot of traders, especially aspiring ones who are just getting started. And there'll even be some great lessons, I'm sure, for the more experienced viewers today, because I'll kind of be sharing a lot of my, key takeaways from my many interviews with market wizards, legendary traders, top performers in the USIC, really top traders that have, mastered their own respective styles. But at the core, even though they trade differently, there's a lot of key principles, and that's what I'll be sharing with you guys today. So we'll be covering 10 different lessons, as well as many different examples of, setups that they trade similarly, how they interpret price action, many, really tangible takeaways that hopefully can help you accelerate your learning curve. So make sure to stick around until the end, and let's go ahead and dive right in. So let's go ahead and get started. Before we get into the key lessons, just a little bit about myself for those of you who aren't familiar. I started trading in late 2018 while attending UMD and getting my bachelor's in mechanical engineering. I took a class taught by Dr. Eric Wish, who is himself an extremely successful trader who's been doing this for 50 years, but he actually trades part-time, meaning his full-time job is as a researcher and professor at UMD. And I took his class, Introduction to Technical Analysis, and then was a TA for the next few years, basically retaking the class because I loved it so much. Back in February of 2020, I started doing interviews with top traders. And these were really instrumental in speeding up my personal learning curve. It was a pleasure getting to meet, as well as, ask as many questions as I want to these top traders. What setups do they use? What's their position sizing? How do they manage risk? All these really important questions that you're trying to figure out at the beginning. I was able to do that. And I really think, I credit that to, helping me, lessen my drawdowns, find my setups faster, and just improving my performance, overall. So hopefully I can pass on those same lessons today. Over here on the right-hand side are a few examples of people who I've been fortunate enough to get to talk to and meet. Many of them are excellent traders. All of them are excellent traders. And it's really just been a pleasure to get to speak with them and, learn from them directly. So hopefully you guys, have found my interviews helpful if you've watched them previously. If not, hopefully you can get some key takeaways if you haven't watched all of them from today's presentation. Moving on, this slide I'm including because my main point is that all timeframes can be successful. I've interviewed traders who like to hold many months and years. Over here on the left-hand side, Kathy Donnelly, a fantastic trader who really has a long-term mindset, trades off weekly charts, looking to capture those full model book moves. And then all the way here on the right-hand side, we've got more intraday day traders, short-term momentum traders, and all along the spectrum, you can be extremely successful at this. There's just kind of important keys that you have to master, and you have to specialize in that particular style. That's going to be a key kind of reframe today. I'm going to say that a lot today. You got to specialize, focus on just a handful of setups, a select few stocks that meet very strict criteria, and then execute with strict risk management as well as discipline as well. But any time frame, whether you're a longer term position trader all the way up to a day trader, you can figure this out and achieve super performance. You just have to kind of focus and be very specific and really married to one style and really just get as good as you can be in that methodology. I want to start off with a little bit of analogy. Say you're an aspiring baseball player, you're a kid, you're 11, 13 years old. You want to be the best baseball player, the best hitter you can be. What can you do to improve your hitting? What are you going to actually go out and do? Well, you might go ahead and, buy tickets to your neighborhood game, watch your favorite player on that team. Maybe he's an all-star, maybe he's an MVP, and you might study his swing. You study how he approaches 2-1 counts. You study how he kind of bears down with 2 strikes, how he always takes the first pitch, and unless it's, it's going to be a strike round in the middle, how a strike right down the middle, how he always, waits for his pitch, ignores the junk thrown into the dirt, as extremely patient and works the pitcher until he gets, his pitch that he's looking for at that at bat. You might study about, how maybe when they go in a slump, what do? They go to the batting cages, they refine their swing, they look at, game film. What are they doing wrong now that they were doing right earlier? What can they tweak to improve? What's the kind of iterative process to get back to where they want to be? You might study all of that. You might read The Science of Hitting by Ted Williams, and, learn all his key takeaways. But basically what you want to do is study success, and learn the key principles that you need to have to be a great hitter. Now that means maybe specializing in, batting average like Ichiro Suzuki, or, more home runs like Barry Bonds. Whatever technique you're looking to master, you're going to adjust your swing, your approach, all of that to suit that style, and then just become the best you can be at it. And you're going to study the greats who have done it before you. It's the exact same thing with training. You want to break down what makes these greats successful, the routines, the habits, the technique that they use, the hard work they put in the cage that goes unnoticed. You only see the games. You don't see all the hours and hours of studying game film, working in the cage, as I mentioned. And you want to take kind of mental and physical reps, hitting extremely mental. You want to visualize success. You want to go up there, knowing that you're going to get that base hit into the gap. And you're going to really work on your preparation, your mindset, so you're in the right frame of mind to approach that at bat, that situation, whatever it is. It could be the bottom of the ninth and, runners on second and third, 2 outs, and you have to get that hit. But you got to be prepared. If you're not prepared, you go up there, swinging at anything, you're not going to have a game plan. You're not going to be successful over the long term. And it's exactly the same as trading. All kind of performance endeavors, and athletics is very much a performance endeavor. Trading is as well. We're not really paid for, trying hard or, working at it. We're paid for results. And with that comes a lot of mental work, but you have to kind of put in the inputs to get to that point where you can be in the right frame of mind to be successful and achieve strong performance. So a big key there was when you're studying the greats, you basically want to reverse engineer what made them successful. Sure, there's going to be talent, when it comes to baseball, athletics, you can't, work hard enough and suddenly you're 6'8" and you're great at basketball. But it's everything outside of, luck that really decides whether you're going to be great at sports. Michael Jordan wasn't just the best because of his athletic abilities. It was his mentality, his work ethic, how hard he worked at getting better every single day. Kobe Bryant, exactly the same thing. So you want to reverse engineer what they did to be the best version of themselves. Maybe an athlete, wasn't going to be an all-star MVP, but they can still become, an NBA player, which by itself is extremely, a select few people ever get to become that. And that's because they've worked hard, they've gritted through it, they've worked hard on becoming a smarter basketball player, not just relying on athletic abilities. All of that comes to play, and you want to reverse engineer the success of, great athletes if you want to be one. And then for traders, reverse engineer what made them successful. What's great about, the current environment and the current times when learning trading specifically is that the pieces are out there often for free. We've got this conference here. We've got all the resources on TraderLion, other channels, other books, which are, extremely low cost from the reward you can get from them. The pieces are out there, and it's up to you to take the initiative and go out and do it. You have to focus inward, compete with yourself from one day, 1 month, 1 year ago. You don't want to be comparing to yourself to somebody who's already been trading for 10 years and, is doing extremely well on social media. You want to focus on yourself, because how they're doing has no impact on your accounts and whether you're growing them or not. So focus on yourself. You can learn from them, but you have to really, take the initiative yourself, put in the work yourself so you can get to that point. Then, and we'll get into this later, you have to conduct post-analysis, study your own performance. What are you doing right? What are you doing wrong? Study your trades. What are your top winners over the past 50 trades? What do they have in common? Maybe go ahead and focus more on that setup. What were your worst trades? What could you just kind of eliminate and it would improve your performance? That's extremely important, especially early on. When I first did post-analysis for the very first time in 2019, I noticed that, I was picking really strong stocks. They were good stocks, but I was getting stopped out, and then it would take off without me. And I didn't know why this was happening, but I went back and studied the trades, marked up where I bought and where I sold. And I was buying basically always, 3 to 4 days late from a tight consolidation, a tight area. I was buying when it was already kind of extended from the proper buy point. And, just kind of as an observer, having traded those names, I would never have realized that, made that realization, if I actually hadn't gone back and done the work, marked up my entries, my exits, all of that, and studied what I was doing wrong. And once I eliminated that, I realized I had to find a better setup, a better entry tactic, buy earlier at the proper time. And that way I was able to manage risk tightly, but also get aboard the stocks that moved well, because when I was buying extended, they would just kind of shake me out with normal price action and then just take off. And I was left kind of bewildered, what happened. But if I didn't go back and do post analysis, I wouldn't have been able to come to that realization. And then this last point here is extremely important. Nothing matters unless you commit to learning, regardless of strategy. So, everybody watching this right now, you are committed to learning. You want to improve as a trader. Point in fact, because you're here watching this right now. So you want to improve, which is the first step and really the hardest step. So now what you have to do is just keep that up for the next few months, years. You're going to always be improving. You see photos of Darvis, like this picture where he's doing his post-analysis work, looking at charts. The legends, the top traders never stop studying and trying to improve. There's always something that you can improve on when it comes to trading, when it comes to life, but especially in trading, there's always something that you can work on: your entries, your exits, your risk management, what have you. There's always an area that you can identify as your current weakness that, if you just improve that a little bit, would really turn the needle and improve your performance. So that's one of the most important keys of reverse engineering success, is come here with a mindset that you're here to learn and you're here to improve. And by the way, that's kind of one of the things that hurts people when it comes to post analysis. They don't want to be vulnerable to the truth of their performance. They're coming in with the mindset that I don't want to make mistakes. I don't want to see my mistakes. But really, recognizing those and actually looking at them makes you a stronger trader. So don't be afraid to be vulnerable to the truth about your trading. In fact, that's the only true way to go ahead and improve. So make sure you guys go ahead and do that. All right, so let's get into the lessons now. First, I've already talked to this a little bit, but trading takes patience and hard work. Again, we've got a legend, William O'Neill, who's inspired so many traders. I'm sure many of you watching here can credit, a lot of your first interest and knowledge about the markets and how they truly work from William O'Neill. Almost every market wizard and top trader I've interviewed over the past few years, credits William O'Neill for part of their system. Maybe not the whole thing. Maybe they've adapted it, but he's provided the framework, Can Slim, which has been successful for decades and decades and decades, and has helped, teach so many traders. So we're all extremely thankful to him. But something that people who knew him and worked with him, Ross, Mike Webster, they always say how hard he worked, how much time he put into this, and how strict he was about putting in that work. So every one of the traders I've interviewed, they struggled for years before finding their footing, but they kept at it. They persevered. They worked through it. They put in the long hours. They went and did a deep dive into a setup, into analyzing the greatest winning stocks of the past 10 years. To achieve better results, they studied the best traders, the best stocks, and then kind of took that knowledge, took their key takeaways, and focused on one specific style and time frame. They made whatever system they were studying, whether they were studying Darvis's style with boxes, William O'Neill's with Can Slim. They made it their own. They altered it to suit their personality, their personal style. Maybe you like to trade Can Slim stocks, but you're trading more as a swing trader. The first, few days after a breakout, that's your bread and butter. And then you just kind of, find the next setup and sell into strength, and aren't really trying to hold for the big move like O'Neill did, but you're still using that same base framework. Many of them read and were inspired by similar books and traders: Darvis, O'Neill, Livermore, Douglas, Minervini. What's great about trading is, you don't really have to reinvent the wheel. You just have to kind of study what the great traders have already done, learn the principles behind their system, and all of those are shared. And a lot of that is what I'm, teaching today in this presentation. So again, you have to put in the work. Here are some recommended books. I always get asked this. So How to Make Money in Stocks, one of the first books I read, excellent, very thorough. In fact, I'm due for a reread. It's right over my shoulder over here. Third tries the charm. It's an excellent book. It's foundational, and it's just, I highly recommend it. If you're going to read one of these books, go ahead and do that one. How I Made $2 Million in the Stock Market. This is maybe my favorite. It was the first book that I got to read. It follows Darvis and when he was, just learning to trade and developing a system. So it's kind of perfect for to read along, because you get to see what mistakes he was making, and they're the mistakes that every single trader makes as they're learning. He was buying extended. He was focusing too much on fundamentals. He wasn't, watching price action. He, was oversizing. He got he experienced too much noise, and that affected him. Every single, obstacle that he meets in that book, you're going to meet at some point along your journey. So go ahead and read that. And that way you've got a warning and you know what to look out for. How to Trade in Stocks by Jesse Livermore, excellent. Reminiscences of a Stock Market Operator, also about Jesse Livermore, is excellent. Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. Of course, you guys got to see him last weekend, which is amazing, but highly recommend that book as well. Watch videos, webinars, write trading rules. I want to emphasize this because in the chat right now, I want you guys to be honest. Do you have a full set of trading rules that defines your system? And is it updated? Maybe you've got something, but it's been a few years and you've kind of changed some things. So let me know in the chat, yes or no, do you have an updated set of trading rules? If the answer is no, one of your tasks today that I'm assigning you didn't know I was assigning homework, but one of my, your assignments is to go out, take 2 days, define your system. What are you looking for in terms of stock selection, market analysis, your setups, your risk management? Define everything that you need to for a similar trader with your same knowledge to follow that system, and he will be trading how you trade. It doesn't take too long in the respect of you're going to be doing this for decades and you want to have, great performance. So you got to invest the time and put in the work and actually go ahead and do that. So if you're watching this conference, you're doing kind of the learning part, but then you have to go out and apply it. That's the next step. And without the application of the knowledge that you've gained from this conference, it's not worth your time. So pay it forward. Your future self will thank you because of the great returns that you've got. Define your system and update it if you still need to, even if you've got an old set of rules that you're currently using. Lesson 2, stay positive, stay focused, stay disciplined. As I mentioned, many traders struggled for years before they became successful. We did a masterclass with John Boyk, and many of the top traders that we analyzed in that masterclass, whether it's Livermore, Wyckoff, O'Neill, many of them took years and years, often I think on average around 6 years to find their footing, develop their system. And that kind of lines up with, one or two bear and bull market cycles. And I think that's kind of what it takes to get the seat time, the experience to, put all the pieces together, because maybe you can learn a setup, but the market won't be right and you're using it at the wrong time. So it takes some time and some real experience to actually apply everything. I'm still, applying stuff that I'm learning and developing, my style. I'm always improving for sure. It just kind of takes that time to figure things out and actually grow confident in your trading. But overall, it really pays to stay positive, to persevere. It pays to be a bull over the long term. Again, 6 years is a very small investment to be able to do this for decades and decades at a very high level. And you want to treat setbacks as learning moments, especially in your first few years. And even though it took the legend 6 years, I think nowadays with the information that we have available, this conference, the interviews that I've done, it shouldn't have to take 6 years. You should learn from others, learn how to manage risk tightly, learn their setups. Of course, you want to adapt everything and kind of master it for yourself. But the learning curve today, I think, has the potential to be that much shorter than what people had to deal with decades ago, when there wasn't the internet, there wasn't YouTube, there weren't the books and resources that there are today. So you should strive to work hard and just get through it as quickly as possible. And again, treat setbacks as learning moments. There's going to be bear markets where you're going to lose a little bit too much, draw down too much. It's just a learning moment, and over time you'll improve. It should be all focused on incremental improvement. Just be a little bit better than you were yesterday, a week ago, a month ago, last market cycle. Just try to improve a little bit over time, and that will really add up over the long term and compound as well. Also, I say here, stick to one strategy and become a master at that particular method and setup. As I mentioned earlier, when we were looking at the time frames, each of those traders really has a focus on, whether it's day trading, swing trading, momentum bursts, longer term position trading, longer term investing, really trading the long term 18 month model book stock moves, whatever their style is, they stick to that and really focus on that. Maybe they have adapted a little bit depending on market conditions, but overall they're staying true to one style and just becoming the best that they can at that. And that involves eliminating the other styles and not focusing on them. Maybe you're a position trader, but there's this, amazing day trade opportunity where the stock has this amazing catalyst. It's up, 200% in pre-market, huge volume. They're going to cure cancer, all cancers. And everybody's caught off guard. And it just has amazing potential. For a day trader, that is the bread and butter. They should go focus on those. But as a position trader, you're not going to be as good at position trading if you're also focused over here and all these opportunities outside of your system. Eliminate the noise, because you might, if you're looking at that, you might not trade it as well because you're not used to the setups, the routines, all of that to be successful at that. You're not kind of programmed to be good at that. But also, if you're focused on other things, you're not going to be the best position trader. You're going to miss those opportunities. And that's what you should be focused on so you can, execute your style and system. Again, you've got to commit to learning. We mentioned this. If you're here today, you're committing to learning, which is awesome. And then you want to judge your trading based on whether you executed your plan, not whether you made money or lost money on a trade. And I think this is the key mindset shift that you can make while doing post-analysis and getting yourself to do post-analysis is every trade that you make, whether it was a winner or a loser, has the potential to help you make better trades in the future. So your biggest loser might actually pay you way more than your biggest winner in the long term, because you might realize a mistake that you're making, or a lapse in your routine, or a lapse in your system that just allows you to blow your overall performance out of the water because you fixed that step. So think about that when you're, not feeling good about a trade that you made. You don't want to go ahead and look back at it, chart it out. Just think about the potential money that you could make by putting in the work and doing post analysis. And here, of course, I've got Jim Ropel on this slide because if you've ever listened to interviews that he's done, it's extremely hard to not be positive, focused, and just fired up to trade and improve. If you've watched, his confidence is amazing, and he's kind of said this multiple times in different interviews. Every year there are model book stock opportunities, and every bull market there's going to be stocks that 5x, 10x, and we just have to stick around and try to get one of those, try to get two of those, and every single year there are more at bats where you can hit it out of the park. So if you have that mindset and think about how long you'll be trading and how many opportunities you'll have to catch the next Tesla, the next Amazon, the next Netflix, that could be even better than those stocks and perform even better, that should get you extremely excited about putting in the work now, so you're prepared when those situations come. And I highly recommend checking out interviews with Jim. He's fantastic, absolutely fantastic, and I've learned a ton from him. Here's some more things about staying positive, staying focused, staying disciplined. Take some time each day to reflect. I've made a very quick kind of Google, what's it called? Google prompt or poll or whatever. I've set it up, to analyze my day. How did I think I performed? What did the market do to that day? What trades did I make? What do I think I could have done better? What's my current portfolio? I've got all that set up so it's automatically, I just fill out the form. It takes 5 minutes, and then I've got that data to go back and analyze. And that reflection, not only helps me if I want to look back and improve something, have that data so I can analyze it, but it also kind of helps me, de-stress from the day. I can leave everything in the form, how I'm feeling, whether I traded well, traded poorly, and just get it out on the paper, and that helps kind of allows me to move on and get on to the fun stuff I want to do, whether that's hanging out with friends, playing soccer, whatever, and kind of leave it all at the trading desk. So make sure you are following your weekend and daily routines. Again, this is critical for making sure you're ready to execute at your best. Again, to use the analogy of it's the 9th inning, runner on second and third, 2 outs. If you're not mentally ready to execute and hit at that instance, you haven't studied the pitcher, you haven't done your warm-ups, you're cold, you're putting yourself at a disadvantage right away. It's the same with trading. If you don't do your routines, whether it's the night before, the day of, if you don't sleep well, if you don't eat well, if you're not in good health, you're putting yourself at a disadvantage, and that's going to lower your performance over the long term. And again, here I also mentioned avoid the noise as much as possible. Twitter, even other traders. Again, you can definitely learn from them. You can study them. There's many people I've learned an immense amount from who are on Twitter. But during the trading day, when it's time to execute, you have to make sure that you're very selective with the information that you use as inputs. And often Twitter is not helpful at all. So keep that in mind. Make it an exercise, a challenge for yourself over the next 3 months to shut off Twitter, close it out. Don't even look at it until 12 p.m. or after the market's closed, even better. And see how your performance changes after you kind of reliant on yourself. You're not relying on anybody else to be posting a stock and then, oh, that looks good, I'll buy it now. Focus on yourself, focus on your own personal game plan. And that will allow you to perform extremely, extremely well. So say no to FOMO, do those routines. That's extremely important for setting yourself up for success. Lesson 3, stay in tune with your own trading. And I kind of mentioned this already with post analysis and keeping a journal. It allows you to keep a mental picture of how recent trades have performed, which is extremely important feedback. All of the top traders who I've interviewed use recent trades as feedback for how much they're going to be sizing, how aggressive they're going to be, what's their views on market conditions. And on the downside as well as the upside, if they start putting on trades and they're working really well, it's the start of a turn, they're going to really double down and be aggressive right at that instant. And that allows them to perform during that uptrend. So it happens both ways. You got to do it both ways, both to the downside, when we've been in a trend and things start, not working so well, And on the flip side, and this is something I'm personally working on, getting aggressive early in the trend as your pilot buys are working. That's what the best traders do. And that's kind of one of the keys to success, is being very in tune with the market cycle as defined by the success of your own trading, analyzing market indexes, leadership. But your own trading is the most important indicator that you have, because, if you're not trading well, by definition, the market isn't right. Or it's not performing, or you're not right for that market, and you should take a step back. But if you're trading well, you should step on the gas and try to get the most out of that period where you're on top of your game and doing extremely well. So take market feedback into account, practice progressive exposure, trade your largest at your best. This is a paraphrase from Mark Minervini, and the smallest when you're trading your worst. Did you have multiple failed breakouts? Stop trades in a row, maybe scale back and reevaluate. Or pilot trades working after correction, increase exposure, be more aggressive. And remember, you are never forced to trade. That's one of the most amazing things about trading. It's like you're at the poker table and you can see everybody else's hands as well as your own hand, and you can decide whether you want to play that hand. If you don't, you just wait until you get a better hand and everybody else has a better hand. You're never forced to trade. Trade when the situation and environment, everything's lining up and it's ideal for you. And take a step back when the deck is cold, and don't force anything just because you need to trade, because nobody needs to trade. Trade when the probabilities are lining up for you, and that's lining up the market, that's lining up groups, that's lining up the individual stocks, that's lining up yourself. Are you ready to trade? Everything needs to come together, and that's the ideal situation. So here I've got a quick graphic, action and effect. Unless you have that feedback loop, you're never gonna really reach that higher echelon of trading and get to your best, because if without feedback you can't improve. I'm an engineer by trade. Every single system that is pretty much designed has feedback loops to make sure it stays on track, doesn't overheat, is producing, optimal energy, whatever system it is, whatever type of system it is, there's feedback loops designed to keep it on track and to get the most out of most efficiency outside of the system. Lesson 4, focus only on high potential stocks. And I alluded to this earlier, but each style is going to have their own definition for high potential stocks. For day traders, it's stocks in play. It's stocks moving on news catalysts that can, trend 30, 100% plus in a day. For short-term swing momentum traders, it's, very tight stocks that can move really nicely for a few days. Maybe it's the start of a bigger move, but you don't care. You're just looking for that short-term momentum burst, and you're looking for that. It's earnings gaps. For position traders, it's more stocks that have maybe the technical characteristics, but also they have amazing growth drivers like earnings, sales. Depending on your style, the characteristics you look for, both technically and fundamentally, will change. And the longer term you are, the more it's geared towards the fundamentals. The shorter term you are, the more it's geared towards the technicals. And you have to kind of find that balance for yourself. But whatever it is, focus on the most superior opportunities that match the exact template that you're looking for. You are never forced to trade. That's one of the most amazing things about trading. It's like you're at the poker table and you can see everybody else's hands as well as your own hand, and you can decide whether you want to play that hand. If you don't, you just wait until you get a better hand and everybody else has a better hand. You're never forced to trade. Trade when the situation and environment, everything's lining up and it's ideal for you. And take a step back when the deck is cold, and don't force anything just because you need to trade, because nobody needs to trade. Trade when the probabilities are lining up for you, and that's lining up the market, that's lining up groups, that's lining up the individual stocks, that's lining up yourself. Are you ready to trade? Leading groups, so they've got the group and sector working for them. There's a theme associated with it. Breakout sales growth, earnings growth. Again, it just kind of has to match the template of the stock that you're looking for. That's the best type of opportunity for your time frame. Day traders, stocks in play, huge gap ups. Maybe, position traders might play that, but not as volatile stocks. Some stocks will pop for one day, and day traders will, make a killing, and that's the end of the trade. They're not going to look at that stock because it fails the next day. Whereas position traders might be looking more for long-term time moves where it can last many weeks and months, and move really strongly, but it takes time to get there. But they can size higher, they can have more conviction because there's a fundamental driver behind the stock. So again, whatever your style is, find the template and create the template for yourself in your own mind, and define it in your trading rules of what the best opportunity looks like for your style. That's the key. And go back and study historical examples to get there, and build a playbook, as we'll get into, for those high potential stocks. Overall, again, a common thing that the top traders I interview look for is that the long-term trend of the price action should be increasing. So here we've got NVIDIA over here. This is the start of the stage 2 uptrend. There's a weekly chart here. We've got a break above the 50-day moving average, the breakout from this base, and we've got this longer term uptrend. Within this move, day traders might be focused on, the days in here, whereas position traders like to focus on the longer term move. Swing traders might be, just selling into strength right here. Whatever your style is, true market leaders can work for you. And they're often the most kind of aggravation free, as Ross Haber says, type of trades. They're liquid. They're being supported at logical spots. Their character is a little bit more learnable. That's not quite a word, but you know what I'm saying. You can gather how they trade and kind of expect things, and nothing's going to catch you off guard until the trend changes. And that in of itself is a signal that you should take into your trading. But a lot of the traders I look for, they're looking for longer term uptrends, and then spots to enter, to play the continuation moves within that longer term uptrend. Here's the Deep View Leaders preset screen, which is available in the platform to everybody. This is the criteria right here. We've got the AND group where all these criteria need to be met, and then these kind of look for different things, whether it's really strong relative strength, really strong earnings or sales growth, or really strong relative strength, or decent sales over the past year, or it's in a longer term uptrend, or it's a recent IPO, or it just is extremely strong. This is kind of my go-to screen. If there's only one screen I would use, it would be the Deep View Leaders screen. And this is kind of, again, just kind of my first group of stocks to fish in. This usually comes up with around 200 names that are in top groups that have the top RS, that then I look for the setups that I look for. And that's how I like to find my trades. But just over here, talking about the mandatory criteria, it has to have a minimum of 20 million liquidity. That makes sure that it's at least somewhat institutional quality, because those stocks, when the institutions are able to trade them, are going to make the biggest moves, or not the biggest moves, but the most sustained, aggravation-free moves. There's going to be names with, less than $1 million volume that can pop amazingly, but it's going to be extremely volatile, and it's just a liquid, harder to trade. ADR, I want to make sure that a stock that I'm trading can actually move. This can honestly be a little bit higher, but I don't want to eliminate too much. 2%, 2.5%. I know Kalamagi has what he looks for. If in the chat, you can put that down. I think it's 2.5 or 3%. ADRs are common stocks over $12.5, market cap of 1 billion. And looking at this mandatory criteria, again, it's going to eliminate some stocks that might 10x, 100x, but it's kind of trying to find and eliminate all the stocks that don't match the template that position and swing traders are looking for. And this will come up with, 99% of the top leaders for each market cycle. At least that, that's been our experience so far. So this is just a recommended screen. If you've got Deep View, you can run this rating presets. If you don't have Deep View, you should check out our special offer. We're building the best platform for swing and position traders, period. We've got a special offer. Like I said, the link should be down below in the description. Moving on to lesson 4, and this is still on focus on high potential stocks. Is just a few things to screen for if you don't want to use that preset. Screen for longer term uptrends, big gap ups on big volume, top 1 month relative strength, top 3 month relative strength, high ADR percentage, group moves, news catalysts, earnings, gappers, themes, crypto, semis, AI, EV, whatever market cycle you're in, there's going to be a key theme or a few themes that are kind of driving the best moves. So if you learn to recognize what those stories look like, you'll be on top of those stocks, before, early on in their trend. So that's a really big key thing that you want to look for. And that's what the top traders do. They analyze, what are the themes that are most active right now? What's the fundamental driver behind them? All right, I'm going to focus on crypto stocks because, Bitcoin's driving everything. All right, AI is going to disrupt everything. I'm going to focus on semis and AI related stocks, and they have the greatest potential now. Keep a running list of these leadership quality stocks, and then you can always look to find your setups, the top 1% of the 1% high potential stocks, and that's how you can find the best of the best leaders. I often see the question, I get asked this, how do these top traders always seem to be in the SMCIs, the NVIDIAs of the day? It's because they're really focused on RS. They're focused on the themes that, are leading the market, and then they're focused on the price action and can work themselves in to those leaders as they're starting or reconfirming moves and building new uptrends. So that's my answer for that. Lesson 5: use charts to identify setups and time trades. Almost every single person, every single top trader, market wizard who I've interviewed analyzes charts in some way. We've got Jason Shapiro, who has his COT edge, and that's a version of charts for sure. But most of them kind of look at price and volume charts, and they analyze them very carefully. They know what their entry tactics look like, their setups look like, the edges that get them onto a stock look like. They basically are looking for standout relative strength and institutional footprints. Again, signs of accumulation, big volume up weeks, gap ups on volume, strong prior uptrends, all of that. And the best traders I found not only, leverage money, but they also leverage time, meaning they're entering a stock when it's perfectly set up to make a big move quickly for their system. And you want to enter at a point where a large directional move is expected, and you can know exactly the point where the setup fails, so you know where to manage your risk and get out. The goal is to be in a profit almost immediately or stopped out quickly, and you can either move on to another opportunity, step back, reevaluate, enter it again the next day if it sets up again. But the key is to master a repeatable setup that kind of fits this criteria right here, because that's the key to be able to manage risk, to be able to size up larger, so you move the needle when stocks work in your favor, and if it doesn't, you're just out with paper cuts. That's kind of the most important key. Ross Haber has a saying: you want to keep your stops tight and logical. In order for you to do that, where it's a small loss if you get it wrong, and it's also at a logical spot that tells you if the setup is wrong, you need to follow this, and that is what allows you to size up big and really move the needle when when you catch an SMCI or an NVIDIA that can make 30, 40, 100% move in just a short amount of time. As Sage Analysis says and Stan Weinstein says, chart reading can help traders and investors of any time frame. I think even if you're long-term investors, you'll benefit from entering at the beginning of stage 2. I put out a tweet a few days ago, I think, analyzing kind of the NVIDIA move up to this point. And actually, I'll go to, here it is. So, this area here, this is the zone for both investors and traders to be looking to enter. And if you're an investor, maybe you're dollar cost averaging during this time, the start of the stage 2 uptrend, or even a little bit before as we get above the 50-day, 10-week moving average. So charts can help your timing, and that, again, leverages your time and money. So you're keeping your losses smaller and your profits, as large as possible as the trend is just getting underway. That's kind of our goal here. Why use charts? Again, you can analyze supply and demand. You can look for those institutional footprints, identify the high potential stocks. You can clearly define both stop loss area and profit taking area. You've got defined risk reward. You can define rules to organize your trading, and you can analyze the trend on multiple time frames. Are you trading with the wind at your back? And this, I think, is a great quote from Tom Basso. The closer you can get your indicators to that which is creating the profits and creating the risk, the more you can control things and run a tighter ship. And, price action is about as close as you can get. Lesson 5. So again, using charts to identify setups and time trades. I'll be going through a few of kind of common setups that these top traders and market wizards use. We've got earnings gap ups, IPO-based breakouts, early stage-based breakouts, as well as VCP type bases. So first up, earnings gaps. This is SMCI, which report earnings right back here. We had a nice gap up, which triggered this breakout. You could enter on this day. You could enter at the tight area after this. There's many ways to play this, but this type of setup is very common. You've seen it from Pradeep, you've seen it from Kalamagi, earnings gaps. Many canceled traders are now kind of adopting this, and it's just a news catalyst that is causing the street to get caught off guard, and the need for them to for large institutions to reevaluate their position sizing, allocate more capital to the stock, which creates this big demand, which not only lasts that first day, but they keep coming back to it because they can't buy just in one day. They have to keep buying on any weakness, and that creates the trends above the moving averages that we can ride as retail traders. So this is an example with SMCI. We've also got ARM earlier this year, where we had a large gap up, huge momentum move the first day, inside day. You could have bought the HVC here, though also try to find a spot intraday here, and then another huge move here. So this kind of shows you the potential for these earning gap type moves, basically very strong performance in just a short amount of time. And for position traders, this can lead to longer term durations, trends that can last, months and even years. I think I don't show ELF, but ELF is a great example for many earnings gaps along the cycle, during that longer term trend. And it can all start there, or you can add there, or it's just a sign that institutions are still being surprised and adjusting their positions. So the earnings gap is a great setup to master. We had Pradeep present the first day. That's a great resource if you would like to learn more about earnings gap ups, as well as just kind of stocks in play and EPs. Next up, we've got the IPO based breakout. This is an example from earlier this year, Shark Ninja. This has doubled since this breakout here. And the IPO based breakout, for me personally and the top traders who I've talked to, they're often not waiting for the breakout through the highs. They're looking for tighter entries up the right hand side. After the stock has kind of shown support, it's built a little bit of a base. They're looking for tight areas, alternate pivots earlier on in the base. We've got one here, this line of resistance, RMV, which is relative measured volatility, goes to 0 in this area, showing it's tightening up. You then can look for that pivot and buy that breakout. You've also got this pivot that forms. You've got a gap and go that is triggered from that tight area. This could have been your entry here. And then you've got a position before that base breakout where often there's volatility. Here, there wasn't really much, but it just allows you to get on that trend a little bit earlier and often manage risk a little bit tighter as well. And this has been a top performer, but the IPO base in general is a fantastic setup. And you can see the effectiveness. We've got PLTR a few years ago. Again, we've got these tight areas shown by RMV. This basically helps you identify VCP characteristics, tight areas that you can manage risk and are showing accumulation. I've got a whole webinar on RMV if you're curious. And the great thing about Deep View is you can scan by it. So you can scan for stocks showing VCPs and tight areas, along with any other condition you want, relative strength, trends above moving average, all of that. So check out Deep View if you haven't already. PLTR, great example, breakout from this tight area earlier than the base, the IPO base pivot, breakout, volumes picking up, and just a beautiful move from the IPO. This was stellar. I think Corsair was also making a similar move, another IPO during this exact same time. Those two IPO moves just kind of are ingrained in my mind. Then we've got ARM from this year. Again, we've got more of a longer term base. This could have been an entry point if we broke out here, but we break lower. We're still basing. Then we start to form higher lows here. This is your first higher low after this one. And then we get a second higher low. And what happens? RMV goes to 0, showing this tight area. This would show up on your screens right in this area. You can buy this subtle breakout, reclaiming the moving averages and moving above the highs right here. And then it even forms in one other tight area as shown by RMV, getting close to 0. And you've got a line of resistance going across. This has been an ideal entry. Strong breakout inside day, reconfirmation. And, ARM has done extremely well this year. It's probably one of the best opportunities of last year in this one. And IPO-based breakouts in general can have these great moves here when the conditions are right. This isn't going to work really in bear markets. But when things are rocking and rolling, these can be great opportunities, as you can see from the ARM chart if you bring it up on your own. Early stage base breakout here. Again, we've got NVIDIA just started its longer term uptrend. We've got the base here. We've got this mini base on top of it. And you could have bought this breakout and just kind of ridden everything that's happened after that. So these early breakouts often have great risk reward because the street is still, institutions are still accumulating. Later on in the move, things get choppier because, some are selling, some are buying. But these early stage base breakouts, if you can identify the theme, the earnings growth, everything coming together, if you can identify them early and buy these early stage base breakouts, they can be tremendous opportunities. And many of the top traders like to find, up the right-hand side entries through tight areas to get in before, that key base pivot. That's a very common thing. Next up, we've got VCP, which is volatility contraction pattern, coined by Mark Minervini. Wyckoff looked for springs. Everybody looks for tight price action. That's a key thing that's shared among the top traders that I look for. And here we've got IBIT very tight in here, RMV going to zero. Again, back here, RMV going to zero. And you get explosive moves from these contractions. Stocks move in between during trends from expansions, contractions, expansions, contractions. And when they're really tight like here, you can manage your risk right at lows, and you'll likely get a stronger move up, which gets you in a profit if it works right away. And that's kind of the key benefit of VCP. Here we've got coin showing a more advanced version of this. Again, we've got a base that forms. We start to form higher lows. This is a higher low. We get a tight range shown by RMV. And then you could have bought the gap up or the range after that or the range after that. RMV again going to close to zero. Tighter entries up the right-hand side. This is a key. If you can take away one thing from my presentation today, look for when a stock moves up the right-hand side, reclaims the 21 EMA, look for tight areas against moving averages, the 10 EMA, the 21 EMA. That's Oliver Kell's EMA crossback. Those are often great, low risk, high reward potential entries because you're getting in before the base breakout. You've got a cushion as we approach that key level in the markets. And you can manage your risk very tightly against those moving averages as well as the lows of the range. So that's why VCPs are so popular. Lesson 6. And, this honestly should have been lesson number 1, especially if you're just starting out. You have to manage risk tightly and use stop losses. Not every market wizard who I've talked to uses stop losses specifically, but they all manage risk very tightly in some way or another. And some of them risk more, some of them risk less. But as a percentage of their account, but they're always making sure this is priority number 1 is managing their risk, keeping their losses small. And if you cannot manage risk, don't take the trade. If you cannot manage risk, don't take the trade. If you cannot manage risk, don't take the trade. If you can't place a tight and logical stop loss, you're not executing a proper setup. Remember that. Per position, the best traders I've interviewed keep stop losses on their positions, on their individual position. This is in portfolio under 5%. Usually they're, 3 to 4%, 5%. That gives, for short-term momentum traders, swing traders, position traders, you can usually find entries, as I mentioned, from tight areas that allows you to do this. And, keeping it this tight allows them to, do extremely well in terms of risk multiples when they do get a winner. And you want to basically cut losses at a fraction of your average gain, 3 to 1, 2 to 1. That's excellent. It builds in failure. We've got a table over here. I'm sure you guys have seen this, but it's the percentage loss required and percentage gain just to break even after you experience it. So as you go down here, you can see the tremendous more amount of work you have to do to get to break even. And this goes into lessening your drawdowns as well as keeping your stops as tight as you can on individual positions, because both ways to look at risk on a portfolio level as well as individual stock level is so important. And this is probably the biggest edge we have as retail traders is we can control very tightly how much we're risking, what our position sizing is, where do we exit if the trade doesn't work. And because of that, we could take advantage of the amazing trends that occur in the markets that are driven by institutions. We can jump on for the ride while risking extremely little in comparison. So this slide and this skill is probably the most important thing. And especially if you're newer, don't don't disregard this because it's not the sexy part of trading. It's not the setups. It's not entry tactics, but managing risk tightly and keeping those losses small keeps you in the game and make sure you're around for future bull markets and around to catch future market leaders. So it's incredibly important. Lesson 7, establish routines and practice discipline. Every single one of the traders who I've interviewed has a defined routine, whether it's daily or weekly, that puts them, as I mentioned, in the best state possible to execute their strategy successfully. Whether that's analyzing the markets, analyzing opportunities, running screens, doing yoga, reading the Bible, everything they do sets themselves up for success later on. So in terms of just some suggestions, weekly routine, you can analyze the market, analyze your trades from that past week. Again, use that feedback to decide how aggressive you're going to be. On the weekly routine, you can build your focus list, the best of the best setups for high potential stocks, outline the entries that you're looking to use, the risk that you'll put on per position, the position sizing. Then in terms of daily routine, you can practice situational awareness, visualize what can happen that day, how you'll respond. And then, previously I've given a similar presentation to this and I said focus on less than 5 names. I adjusted that down to 3 names because that's what I found personally has been one of the best things I've done personally in my own trading is focus on less, focus on, only 3 names pretty much each day, the best of the best names, and just kind of disregard everything else until, your trading is done for the day and you can kind of analyze the market as a whole. But focusing on less stocks on your focus list allows you to execute so much better on the stocks that you do choose. It's no good watching 15, 20 stocks when, one of them might have been amazing you'd missed it if you only were focusing on 3. But the key thing is you wouldn't have executed well on that stock that did well because you're trying to watch too much. You're trying to watch all these charts and everything's happening at the open. You guys know how hectic the open is. Everything's moving on volume and you really have to be very selective in the best setups, the best entry tactics that you can use. And then you want to use the technology that you have. Use something like DeFi where you can set alerts just below key pivots so you don't have to watch everything all at once and you're going to set yourself up for success and have a better chance of catching a stock at the proper buy point if you use alerts. So make sure you're using those to the fullest ability and then just go ahead and execute. And after you're done, review your trades, think about what you could have done better, pick the top setups for the next day and just kind of move on and gradually improve. And we've got a quote here from Jim Rohn. Discipline is the bridge between goals and accomplishment. So right now, if you've got some goals when it comes to trading, to become a market wizard, to win the USIC, whatever it is, you have to set yourself up for and build a system for yourself that allows you to get there. And then you have to be disciplined enough to execute that system. Without the system, without the discipline, you're not going to reach the goal. It's as simple as that. So you have to have kind of all 3 of those components and dream big for sure, but set yourself up for success and be realistic. And then also be ruthless in how you execute that system. So you put yourself in the best possible situation. Lesson 8, sell systematically and objectively. Selling is one of the hardest parts of trading. It's always going to go up more when you sell. It's always going to, if you don't sell, it's gonna break the key moving averages and take you right back to your entry. But the key thing is, you got to follow your rules. All the top traders who I've interviewed, they've got a system for when to sell, and they just kind of execute ruthlessly. Again, you have to decide whether you're going to be selling into strength or weakness. I would say the shorter your time frame, again, going from position trader, long-term investor, position trader, swing trader, day trader, the shorter your time frame, the more you probably want to sell into strength. Because your edge is kind of in turning over your edge a lot if you're shorter term, versus if you're longer term, your edge is kind of built by sticking with a strong performing stock through the wiggles and jiggles, as long as it's still it still has a strong longer term trend. So it's kind of different objectives, momentum moves versus duration moves, as I think Pradeep likes to say. Focus on your statistics. If your average gain is 10%, and you get a 20% winner, and your edge is kind of a 3-to-1 with a 10% gain, look to sell some in strength, lock that trade in, and then let the rest ride. You can use moving averages to kind of define a trend for your system if you want to, hold and sell into weakness. I really like the 21 EMA. I think it's amazing how it catches the majority of the moves from base to base. Check it out on, past historical winners. It just kind of works. And then just kind of develop a repeatable and consistent method. Study your winners, stick with the trend. For me, I like to use two closes below the 21 EMA in a strong market to define kind of my exit. Or the 50 SMA, that's excellent as well, especially early on in a bull market to really give a stock room to work with. I personally don't have really the personality and patience to sit through a base, longer term base where it's pulled back 20, 30%. That's why I like to use the 21 EMA to get me out when that, intermediate term momentum move has happened. And then, if it sets up again within the base at the right hand side, I'll then go ahead and jump back in. Whether the price is higher or lower, it doesn't really matter. It's a new trade for me at that instant. Lesson 9, concentrate into positions. This is one of the biggest takeaways, that I had, getting to interview all these top traders is they would really position size pretty large in their highest conviction names. We're taught, at basic financial literacy, investing, whatever, to spread out your bets, so you can't, go broke on one investment. But it's completely different story when it comes to trading because you're managing risk through your stop losses, your entries, all of that. You're not trying to diversify. You're trying to concentrate in the strongest names that in itself is going to provide some safety. It's of course no sure thing, but position sizing large into a strong stock with tight risk management is taking care of that risk management. And it also allows you to, when you catch a winner like SMCI or Nvidia from 2024, 2023, it really moves the needle and gets you that cushion that then you can use however you want to invest in the next stock, or what have you. And less positions allows you to focus more on each one, which again allows you to execute better overall. So the top traders who I've interviewed, most of them trade 2 to 10 positions. Many of them trade, 6, 7. They often have sizes of 20% or more in high conviction trades. Some of them are much more than that, 60%, 80%. They're on full margin and they're putting half their account in one stock, half the account in the other. Now, to do that properly, you have to know how to get into those stocks while managing risk. You're not just kind of blindly, I'm going to put half of my account in this stock and hope it works. You're using entry tactics to keep your risk really low if the stock does move against you and doesn't do what you expect. Less stocks also allows you to learn how each stock trades, so you notice character changes both to the positive and the negative. Just a few strong stocks can make your year, but again, you have to manage risk tightly with tight entries, entry tactics to manage risk. Otherwise, you can't position size that much higher because you can't take many 10% losses on a 20% position in a row. You have to cut losses a lot shorter than that if you're going to be successful while sizing pretty large. But this is one of the biggest keys to getting super performance is being able to confidently and while managing risk, concentrate large position sizes when the market is right and everything is lining up at the start of a new uptrend, in the start of a new potential market leader. Lesson 10, we've kind of gone through this a little bit, but it's worth going over again. Conduct post-analysis. Identify your weaknesses. How many, baseball players or football players watch game film? Why do they do that? They do that to identify the weaknesses and identify the things that they can change that will help them win more games in the future, get more hits in the future, hit more home runs in the future. It might suck to watch yourself strike out, but if you notice your Achilles heel, a tell that you always swing at, curveballs, outside and low, if you just eliminate that, you'll put yourself in a better spot mentally as well as physically later on at future at bats, because you know your weakness, you know what to avoid. And just like trading, if you just eliminate the stuff that you're making most of your mistakes on, your performance has to improve. And that's such a big key. And this is true for investing. This is true for trading. Study what you did right, what went wrong. Did you follow and execute your plan? What could you change about your plan in the future? What were some of the common aspects of your best trades? What about your worst trades? What is your average gain, your average loss? Are you cutting losses properly? What can you improve on? What rules and routines can you create to do so? It's all about kind of putting in the work, analyzing yourself, analyze your performance, so you can overall, improve incrementally through studying yourself. There's a reason the best athletes do this religiously. It's because it's the number one thing that they can do to improve their games, and we want to do that same thing as traders. So here's my homework, my additional homework for you guys. Go back and study NVIDIA's move from early 2023 to 2024, because not only is post-analysis studying your own personal trading, but it's also about studying the best opportunities that were available for your system during a set piece of time. So if you missed SMCI, you missed NVIDIA, but you should have gotten it, you got to analyze why, so you can catch the future ones. So go bar by bar. On each bar, would you buy, hold, sell? How much? What is your kind of mental expectation for the next bar? What were some key price and volume characteristics? Which setups worked? What entry tactics? Where would you have entered? Where would you have exited? What news theme drove the move? When did those come into the marketplace? Summarize this exercise in a report. You might just make your own model book, which, if you haven't made one yet, is awesome. And if you do this exercise, tag me and TraderLion on Twitter. We might, for people who do this, we might be doing a giveaway. No promises, but we'll look to do that. And just doing this practice will teach you so much about how true market leaders move, what gets them started, where you can enter while managing risk, which is so important. And studying the top opportunities just allows you to improve your system, improve your routines, so you can catch the next leader like NVIDIA. All right, so we've covered a lot of lessons today. Hopefully there's been some golden nuggets in here. Let me know in the chat right now kind of your favorite lesson that I've covered. But here's kind of a lot of it summarized into a template for trading success. Pick one trader, one of the conference speakers from this year, who you most relate to and whose style most matches yours. For me, it was Oliver Kell. I got to work with him on the masterclass that we did and really get to talk with him immensely. His price cycle completely changed how I interpret price action and trade. And my style, I related a lot. Everything he said made sense. So if there's somebody who has a similar effect for you, kind of choose them. Study interviews that they've given, books they've written, articles, masterclasses like we have at TraderLion. If Stan or Oliver is the person for you, look for what criteria they use for stock selection, what setups do they use, how do they size, how do they manage risk, how do they sell, what market conditions are they most aggressive in. Pick one setup that they use, trade it and research it for yourself, collect historical examples, build model books, and then just apply what you've learned through all of this, and use that as your foundation. And you're not going to be trading it as successfully as they are to start with, but you'll have a huge leg up in terms of if you otherwise just kind of went and did random things and try to figure everything out for yourself. Start with the foundation of success that they've already built, and then add your own spin to it as you gain experience and gain more know-how. So pick one setup, trade and build confidence, learn the nuances of the setup, how they trade, how you trade, manage risk. And again, this takes time. It could take, one or two market cycles at the very least. And, over the course of your career, you're always going to be learning. There's people who I've learned a lot from, for instance, Eve Bobach, who's been watching this conference and has texted me that it's been amazing getting to listen to these speakers. She's been doing this for years and years, is extremely successful managing a fund, and she's still out here learning. And that's ultimately why she's successful, because she has that passion and drive to learn and improve and gain whatever edges that she can, even though she's already, made it to say that. So you can always get better. There's always something that you can improve on and something you can work on. And lastly, to channel my inner Ryan Pierpont, you can do it. If you listen to the stories of great traders, they all started knowing nothing, struggling. Every trader, I think, has gone through periods where they feel like, oh, I can't do this. I've got this huge drawdown, but you just have to persevere, look to improve your system, and really change things. If you're not performing well, you have to put in the work and identify what you need to change to be successful. But even if you've kind of, you're on the right path and managing risk and all of that, there's still going to be periods where you're feeling down. You feel like you can't quite be successful, but you just kind of have to put in the work. Study the great traders, study the great market cycles, study stocks. Again, we did the masterclass with John Boyk where we basically did this. We studied every market cycle, and John kind of guided everybody through all the market cycles, what drove them, how long they lasted, how do they start, how do they end. Going all the way back to, the early 1900s. And then we also studied great traders, how they traded during those periods, the great stocks that they traded. So studying all these helps you build that historical template that then you can apply to current markets and of course adapt, but it provides you with that great foundation. So again, these traders, they went through turbulent times of success and failure. They persevered, they kept at it. And if they can do that, so can you, especially because you've got access to way more resources than they did. You've got access to books they literally wrote, videos they made nowadays. So if they can do it, so can you. And now remember, go ahead and do your homework here. I expect to see a lot of responses. And again, I kind of mentioned this earlier, dreams stay dreams until you act. So go ahead, set a plan. Don't just watch this conference, study it. And to really study something, you have to apply it. It's no good studying a resource or saying you're studying a resource unless you actually apply the key takeaways from it. So my challenge to you guys, everybody watching, take one golden nugget from this conference, whether it's a setup, whether it's something about risk management, and go ahead, build a rule around it and use it in your trading next week. That's kind of my challenge to you guys. So with that, thank you guys so much. It's been a pleasure to present at the conference. Hopefully you guys are enjoying everything. And if you are, please go ahead again, leave a like down below on the stream, subscribe to the channel. We've got amazing resources coming your way. Great to have you guys here. And I think at this point, we'll go ahead and close it out and we'll be right back with the next presenter. So again, thank you so much. Leave a like down below, subscribe to the channel, check out the many resources that we have here, as well as over at TraderLion University. Again, if you sign up for the free VIP, you get access to all the slides that not only I presented, but every speaker, and you get access to model books, other free resources, conference resources, podcast resources that again help you study the greatest traders, the greatest stocks, and market cycles. So don't miss out. Sign up for a free account, check those out, and we really hope sincerely that it helps you shorten your learning curve. So go out and do it. And I hope to see a lot of people's homework on Twitter over the next few days. Maybe the person who posts it first, I'll give them a special something as well. So thank you guys all for tuning in. Hopefully this is helpful to you. We know it can be a little bit overwhelming, all the different presenters, over basically a month at this point with the TraderLion conference. But the key thing is to really focus your attention on what can help your trading the most. Maybe it's not even somebody who trades like your style, but they said one thing that can really help you and you can apply. So just add that layer to your process, see if it sticks, and just make those incremental improvements. So thank you guys again. And we'll be right back with the next presenter. Stay tuned.